With its first rate hike last week since 2018, the Federal Reserve laid out an aggressive plan to address uncomfortably high and persistent inflation. In addition to a series of rate hikes, we think the Fed will soon further outline and initiate its plan to reduce the size of its balance sheet, further encouraging higher interest rates. If elevated inflation persists, we see a high probability of the yield curve inverting following an over-aggressive trend of rate hikes that may slow economic growth. Let's take a closer look. The Fed increased its policy rate by a quarter percentage point to the range of 0.25% to 0.5% at the Federal Open Market Committee meeting last week, which investors largely anticipated. But in more striking news from the meeting, the median forecast from a survey of committee members shows 6 additional rate hikes in 2022. The survey also indicates a forecasted peak rate of 2.75% by the end of 2023. The forecast suggests the Fed funds rate will exceed the neutral rate forecast of 2.375% in 2023 and 2024. A rate higher than the neutral rate forecast, which is considered neither accommodative nor restrictive to economic growth, typically implies too much tightening at the cost of economic growth. Over the past 2 decades, every time the Fed has increased rates approaching the neutral federal funds rate, the Fed has had to reverse quickly with aggressive rate cuts as the economy slowed. Treasury yields rose following the meeting, with short and intermediate maturities rising the most, flattening the yield curve. However, investors continue to wonder how well the Fed will be able to successfully balance aggressively tightening monetary policy while maintaining the current low level of unemployment and avoiding a severe decline in economic growth. Inflation remains the most important indicator for investors to watch, as we think it will determine the magnitude for further rate hikes throughout the year. At the moment, strong aggregate demand, persistent supply constraints, and upside pressure from energy and commodity prices, fueled by geopolitical uncertainty, support continued high inflation. If inflation remains unanchored, we expect the yield curve to flatten even more, with a high probability of inverting, a signal investors associate with a weaker economic outlook.